Thanks, Kelly. President Kaplan, thanks for joining us. I'm not sure if you knew you would sign up for this, but you're the first guy out of the box to comment on this new policy that came out this morning. So getting right to it, tell us what this idea of averaging inflation means for markets, for investors, and for the economy. How does it work in practice?
So here's what it means to me. First of all, I think it's an articulation of my reaction function that I've been following for the last few years. And what do I mean by that? Historically, when we got to levels that approach full employment, the Fed would want to preempt. It would anticipate inflation. It would want to preempt it, and it would start raising rates. Up until the pandemic, we let the economy run hotter. We let the unemployment rate get lower. And I was more hesitant, and we were more hesitant to preempt or anticipate inflation. And we had the luxury of doing that because inflation was more muted. To me, this is not a formula. It's not a commitment. We're not going to use an arithmetic average. It simply means to me, as we get down to lower levels of unemployment, I'm going to be willing I'm going to look at a whole range of circumstances and factors. And if I think inflation is likely to be muted, I'm willing to take a little bit more risk and have a little more tolerance for a modest overshoot. And I say modest overshoot, but that's really been my reaction function for the last 2 or 3 years.
But President Kaplan, you're the ones who use the word average. And at the same time, you and Chair Powell said it's not a formula. So the word average begets markets are going to start thinking about a formula. So I have to ask you, if it runs at 2.5% for a year or 3% for a year, does that mean you would sit tight?
It'll depend on the circumstances. I wouldn't. For me, the new framework says we're likely to let inflation run moderately above. What does moderate mean to me? Probably means to me 2.25%, 2.5%. You've heard me say before over the last few years that our inflation target was symmetric. I don't want to run persistently below, and I don't want to run persistently above. And for me, at least, that hasn't changed. And so I know people may try to come up with arithmetic averages, but I won't be following that. And this framework also is not a substitute for my judgment. I'll be looking at a whole range of factors when I make these judgments in the future. And it's not a commitment, again, on what we're going to do.
You already addressed this a little bit, but I think it's worth underscoring. A lot of talk about average inflation, but also a pretty important change in the long-run policy statement about unemployment. You said you're going to address shortfalls in unemployment, not deviations. And I believe the change in wording has to do with the idea that you're much more concerned about unemployment essentially running too high than you are running too low. How big a change is that for monetary policy?
So it's a change, and to me, it reflects a degree of humility at the Fed. If you'd asked me, I joined the Fed 5 years ago, and if you asked me and my team what was full employment, we might have said 4.5%, 4.75%, and obviously that turned out in hindsight to be high. We were able to pull in a whole range of underrepresented groups, lower income groups, blacks, Hispanics, women with high school education and less. And so what this reflects is that maybe our views on full employment are more imprecise than we might have thought, and that we may have the capacity to run hotter than we have in the past, and we're at least open to that. So that's the reason for shortfalls versus deviations. And it also highlights the importance of getting underrepresented groups into the workforce and the long-term benefits that can have on income inequality, wealth inequality, and having a stronger economy with a stronger labor force.